Hi everyone. Let's take a look at this divisional performance analysis and evaluation problem. It's problem 23-5B. The Vice President of Operations of Cantor Simmons Cycle Company is evaluating the performance of two divisions organized as investment centers. Invested assets and condensed income statement data for the past year appear in the table. I'll move my mouse so you can see where the table is, okay? So we've got the road bike division and the mountain bike division, and we have sales data, cost of goods sold data, operating expenses, and invested assets. All right, now instructions to part 1 says, prepare a condensed divisional income statement for the year ended December 31st, assuming there were no service department charges. Let's tackle that part first. I'm going to slide up now. Hopefully we'll still have some data on the top that we can see it. All right, so here we have the divisional income statement for the year ended December 31st, and pretty much this part of the assignment is really just copying the information we have from above. We have the road bike and the mountain bike, and then I'll reveal the answers here, and we would list sales less cost of goods sold, then we'd compute gross profit, then we'd back off the operating expenses. So all we're doing is taking the information from above, computing gross profit, then coming up with operating expenses, and eventually we come up with income from operations. And that's all there really is to part 1, since there's no service department charges. Okay, then on part 2 it says, use the DuPont formula for rate of return on investment and determine the profit margin, the investment turnover, and rate of return on investment for each division. Okay, let me slide a little bit. Okay, now I think we have all the financials here. We just need the invested assets, so hopefully we can see this. Let me slide down, and we'll reveal the formulas, right? And that's the formulas we're going to use. Okay, so the DuPont formula is essentially determining the rate of return on investment, or ROI, by breaking it into two components. One I'll call the income statement efficiency component, which is the profit margin, right? It's the return on sales is measured by an income statement. And then we take sales divided by the invested assets to come up with the investment turnover. So rate of return is equal to the profit margin times investment turnover. And then when we split those out, we break it into its pieces. All right, now the invested assets are $600,000 and $11875 for each division. Let's slide a little bit so give us a little bit more room to see what we come up with. All right, so to determine ROI, what we would do, let me do this for the road bike first, we would take the $150,000 to the left of my mouse of the income from operations and divide it by sales. That's this part right here, to the left of my mouse now where I'm moving it. And then we have to determine the investment turnover, and we take that same sales data of $750 and divide it by the invested assets, and that was given up top as $600,000. So when we multiply the 20% profit margin times the 1.25 investment turnover, using the DuPont approach, we derive a return on investment of 25%. Now we'll go through that same logic for the mountain bike division. Okay? And that takes care of part 2, right? We're doing the exact same items. We take the 209 divided by sales, then take the invested assets, which were 1187500, put sales on top to come up with investment turnover, then multiply the profit margin times the investment turnover, and we wind up with the 22% times 0.8%, or return on investment of 17.6%. Okay, now, part 3 says, if management desires a minimum accepted rate of return of 18%, determine the residual income for each division. All right, so let's take a look at how we compute residual income. And we'll do the road bike first. All right, what we've got to do is we've got to take the 18% times the $600,000, which was given as the invested assets, and we have to subtract that from our real return, which was $150,000. Okay, now I've slid the the barrier, the blue barrier down so we can see how we do it with the mountain bike division. And here, the mountain bike division had $1,187,500 of investment dollars, and we multiply that times the 18% rate, and then subtract that from its income from operations, which was 209. Right to the left of my mouse is where that came from. And so we see that the mountain bike division, although it generated $209,000 of income from operations versus $150,000 from the road bike division, we see that in terms of this measurement, which is residual income, the residual income is actually sitting in a loss position. Okay, now I've slid back up to the top where we can look at number 4, where it says to discuss the evaluation of the two divisions using the performance measures that we determined in 1, 2, 3. All right, so if we look at 1, 2, 3, we can reach some conclusions. On the basis of income from operations, the mountain bike division generated more money than the road bike. I think that looks like $59,000. But when we consider the amount that's invested in each division, we get different results. For instance, on the basis of the rate of return, the road bike division earned 25 cents on the dollar, or 25%, for every dollar invested, while the mountain bike division only earned 17.6%. And so what that means is the road bike division has a higher return on investment than the mountain bike division, right? 25 versus 17.6. And then when we look at residual income, we see that residual income really is a factor or sort of the results of both 1 and 2 above. And we see that the road bike division is clearly more profitable based on residual income. And that's this problem, everyone. Thank you.